Hi, it's Vinith from Finance Taught by Teens, and today we're going to be looking into why too much diversity can actually hurt your portfolio. But before we start this video, please like, comment, and subscribe. So before we get into why diversification is actually bad, we need to go over the three most common types of funds. Mutual/index funds, which in terms of diversity are essentially the same. So the pros are low risk in terms of your losses. It's pretty low risk but low returns. You have pro consultants that help you invest. It's very simple to understand, but the cons are it's too diversified. There's lots of hidden fees. There's little capital protection, and if something goes wrong, you're not guaranteed any of your money. In ETFs, exchange trade funds, the pros are they're easy to trade, which is why they have the name ETF. They're popular to day trade, which I don't recommend doing, and they have low operating costs. The cons are they're very high risk, requires extensive knowledge, and they need to be actively involved. So that means basically you need to be day trading them, which again I said I don't recommend. So now let's get into why diversification does not lead to long-term success. But before we start this, there's another slide, so don't click off. Diversification typically means lots of stocks and investments, each worth a small portion, meant to ensure security and minimal loss. And why is this bad? It sounds good, but remember, most investors are not day traders. The point is to ensure long-term returns, and lots of diversity will result in essentially no returns. The reason for this is, say you have 50 stocks. Each one of them has a really small portion. Say half of them succeed and half of them fail. That will even out to maybe a little bit of a return, but not much. But when you invest the same amount of money into 5 to 10 select companies, if you have done your research right, then eventually your returns will be much higher. And the overall message is your portfolio should have 5 to 10 stocks, with one having a maximum of 20% of your portfolio. You should not completely rely on mutual/index funds, and the main reason for that is they're used a lot due to the misconception that they're safe and the professionals will handle your business. Having a lot of stocks does not promote gains, and if you're looking to make gains immediately, day trading is what you should be doing, which I highly do not recommend. Most importantly, your portfolio should be a few select, well-researched investments that should not be actively managed. For most people, should not be a steady income, and once you invest, the goal is to eliminate your stocks in the far future by selling and trading. This means investing in startups with extensive research and not relying on mutual/index funds completely. The key is patience, and you should not be thinking about your immediate returns. Thank you for watching, and once again, please like, comment, and subscribe.